Hey guys, Brand Asset Management here, and today I'm looking at the Coca Cola company, ticker symbol KO, using my 7 simple steps. Let's have a look at the share price over the last year. So at the start of the pandemic, it was at around $60 a share, then hit its 52-week low at around about $36 a share, and has rebounded pretty strongly, but then dropped off recently and is now at $51.28 a share. So if we just want to compare it to the market in the last year, the market here is in green, Coke is in blue, so you can see it has underperformed the market in the last year. In the last 2 years you could see it was previously beating the market until the pandemic hit and is now underperforming again. But if we look over the last 5 years, you can see it's actually grossly underperformed the market. So it doesn't look good for Coke there, but if you compare it all time from the 60s, you can see that Coke has massively outperformed the market. So that's why you hear about all those Coca Cola millionaires in the 60s, because they purchased Coke rather than the market, and as you can see, it's completely blown out the water. So over the long term, Coke's been better, but over the last 5 years, it would have definitely been better to buy the market. But let's see if we think that can continue. So as I said before, the current share price of Coke is now $51.31 and it has a 221 billion market cap. So let's head on to my 7 steps. Is the P/E ratio less than the market? Coke's current P/E ratio is 28.66, the market is 21.5, so that is a fail. Their price per earnings is higher than the market. Also, if we compare P/E ratio versus the sector, which is step number 2, Coke is 28.61 compared to 27.3 in consumer defensive, so that is a fail again. Now let's head on to the financials for my next step. Step 3 is the revenue increasing, and the revenue has gone from 35 billion to 33 billion, so that is a fail there. Revenue has slightly decreased. It's increased over 2018, but from 4 years ago it has failed, so that is technically a fail. Now we want to look at, is the profit increasing over the last few years, and the profit has gone from 1.2 billion to 7.7 billion. So that's a massive check mark. The profits increased massively over these last years. Now we want to look at, are the shares outstanding decreasing or flat, and the shares have gone from 2.72 billion to I'll say that again, sorry. The shares have gone from 4.272 billion to 4.295 billion. So that is actually a fail. They've increased slightly. Coke has issued some more shares over the last year. Just quickly before we head over the balance sheet, I just want to say thank you guys for watching. Give a like if you enjoyed the video. Leave a comment on your thoughts on Coke down below and what stock you want me to review next. And now let's head on to step number 6. Are the current assets greater than the current liabilities? So the current assets of Coke are 19 billion and the current liabilities are 14 billion. So check mark, they can pay off all the current debt with the current assets. That's good news. And they can pay just under half as their sorry, that's mistaken again. They can pay just under a third of their total liabilities. So not an extra check mark, just a point to note there. And the final step is the free cash flow increasing, and to get the free cash flow we take cash flow from operating activities minus capital expenditures. Yahoo Finance does it from here. So 4 years ago the free cash flow was 5.5 billion and now it's 8.6 billion. So that's a check there. The free cash flow has increased over the last 5 years. So to take an average of these, that gives me a average free cash flow of 7.2. So I'm going to be looking at their trailing 12-month number as that's the biggest. So to get the free cash flow yield, I divide the free cash flow by the enterprise value, and to get the enterprise value, it's the market cap plus total debt minus cash and cash equivalents. And Coke currently has an enterprise value of 255.86 billion. So that gives a free cash flow yield of 3.39% and a free cash flow ratio of 29.5. So those values are within the boundaries that I'm looking for, normally indicate that a company has good free cash flow. So despite only passing 3 of the first steps, it is looking good due to the free cash flow yield. Just heading over to Dividend Max here to look at Coke's dividend. This is a thing that people are very interested in when they look at Coke, and it does pay a quarterly dividend with a dividend per share of 42 cents a share. And the ex-dividend date is the 12th of March. So if you buy your shares before the 12th of March and hold shares on the 12th of March, you will get your Coca Cola dividend on the 1st of April. So it currently has a 3.3 dividend yield. So if you had 125 shares of Coca Cola, due to your next dividend payment, you could actually purchase a free share of Coke. So that's good news if you have a lot of Coke at the minute. So just quickly looking at some of the analyst ratings here, overall they say they have it as a hold, but leaning towards a buy or a strong buy, with 15 holding, 7 buying and 3 with a strong buy, with a recommended rating of just under a solid buy with a 2.1. So looking like a buy from the analyst ratings. Let's have a look at the price targets. And Coke's price targets range from as low as $50 to as high as 67. So when the current price is 51.3, that's looking very good. And they have an they have an average rating of 57.59. So the analysts do think Coke is a buy, and they do think it has a lot of room for growth, which is very good. Just looking at the earnings per share, you can see that Coke has consistently beat the earnings per share of the last 4 quarters, so looking good. Analysts estimating the earnings per share at 0.5, so let's see if they beat that. And just looking quickly at Simply Wall Street here, they have it at a fair value of $64.36 a share, meaning it's 19% undervalued. So they think it's trading below their fair values, and not by a significant amount, but definitely enough for them to purchase the share, as they deem it under 20%, and it's currently 19.8. So just to quickly summarize my 7 simple steps, the P ratio was not less than the market with 28 to 21, so that's a fail. P ratio was also not less than the sector, 28 to 27, another fail. Revenue had decreased with 35 billion to 33, so that's 3 fails off the bat. But the profit had dramatically increased from 1.2 billion to 7.7 billion. Shares outstanding had slightly increased, so that's 4.27 billion to 4.29 billion, so fail again. Coke can easily pay off their current liabilities with their current assets with 19 billion to 14 billion, and their free cash flow has most definitely increased from 5.4 billion to 8.6 billion. So that is 3 check marks and 5 failures. Based on the steps, it's not looking like a solid buy, but what we have to take into account that it is increasing free cash flow and has a very good free cash flow yield and a very good free cash flow ratio. So now let's have a look at my discounted free cash flow model to see what I think about the stock. So unsurprisingly, if we look at the free cash flow, I've got it increasing over the next 4 years. Analyst estimates would agree with me on that, and I have it at a calculated stock price of $82 a share, meaning it's 58% undervalued with that free cash flow yield of around about 3.9%. So according to the model, it is a buy based on the discounted free cash flow. Coke's normally had good free cash flow over the last few years. I think the share price does have a lot to grow, but interestingly enough, if I look at the Buffett-Graham intrinsic value here, due to Coke's low earnings per share, they actually have it a fair value at $33.97 and a Graham price of $25.48. So that is very low. Even in the pandemic, Coke wasn't even that low. So I think that is a bit of a low, very bearish signal. It's a slower growing company, yes, but looking at the free cash flow, it does have more growth there. So the sweet spot to me, I think, is in the middle of these two numbers. I think Coke can probably go up to anywhere between $60, $65 a share in the short term. I am a owner of Coke. I'm looking forward to their dividend and have been happy with them so far. So just quickly looking at some of the technicals over the last year, I have a 50-day moving average here in grey, and I have a 200-day moving average here in gold. So there was a death cross at the pandemic, which would have been a sell signal. This is after the price hit its low. The price has been pretty in line with the 50-day, and there was a golden cross in October, which would have been a buy signal, and then another buy signal here when the price blew past both averages. So you would have bought there, held on, and sold here when the price dipped, so you would have made some money on that trade there. Then there's another bearish signal here where the price actually hit the 200-day moving average, but there was some resistance here. As you can see, it's popped back up. So the price has broke the 50-day moving average again. What will it do? These lines are starting to converge again. Yeah, I'm not too sure where this is going to go in the future. I am hoping that Coke's price continues to go up, but there was definitely a lot of signals here to buy and sell at different points. So you could have made some good money here based on the technicals. Right guys, I want to thank you all for watching. Give a like if you've enjoyed the video. Give a comment on your thoughts on Coke. And also give me a comment on what stock you want me to review next. A lot of people have been saying Amazon in the comments, so I'll probably be going with that. But if not, I'll see what you guys say. So thank you very much for watching, and I'll see you guys next time.